Good afternoon, ladies and gentlemen, and welcome to the MIRADA full-year results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet company dashboard, and you'll be notified by email when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Jose Valquez, CEO for MIRADA. Good afternoon, sir.
Good afternoon. Thank you very much, Mark. And thank you all for attending the meeting today. We are very glad to be able to make this presentation for all of you. You probably know me, or some of you know me. The poll says that about 50% of the attendees are shareholders, already shareholders of MIRADA PLC. This is basically half and half. So I will try to dig a bit deeper on the information about the company and what we do. So my name is Jose Luis Batkett. I'm the CEO and founder of the company, engineer by training with a financial background. The company in a different position was founded like 20 years ago. And as MIRADA, we have been public for about 12 years now. With me, it's Gonzalo Babillo. Gonzalo joined the company about 5 years ago in the post of CFO. He's finance director now, and his background is he was the CFO for the Disney Group for Spain and Portugal for 10 years, and before that, he was also CFO for Electronic Arts video gaming company. So thank you very much again, all of you, for attending. I will now jump to the slide to tell you a bit about what we do. First of all, and most important, we are a software company. Software travels very, very well, especially in this connected world. And the sector we do software for is the video and entertainment sector, media sector, and especially our customers are mostly pay TV operators and content providers. In the UK, they would be people like in the likes of Sky or Virgin Media or BT, those providing TV services. Content providers more and more accessing customers in a direct-to-consumer way, D2C, we call it in the argot. And this could be people like Netflix or Disney or Amazon. So we are one of the top 5 companies in the world developing software to allow consumers to use our services to consume content, to browse content, to find content, and to enjoy it. So we provide the software for the big guys, for these TV platforms, and they deliver for final subscribers. We have one of the most compelling propositions in terms of our product for the market. I will tell you about that a bit later. But MIRADA is not just a new company. MIRADA is not a startup. MIRADA is present in millions of subscribers, households at the moment. And we have very, very relevant customers, as you will see in this slide, and we will tell you a bit more in depth later. So of these 5 elements in this slide, I would like actually to remark the second, our customers. Our customers are quite sticky customers. What does it mean? It means that when we win a customer and when we deliver, it takes very long for them to change the software. It's very difficult for a pay TV platform to replace the software they use for their final subscribers because of the devices, because of the backend technologies, the servers, because of the complexity of the technologies that are used. So typical lifetime for a deployment is between 5 to 10 years, usually more than that. So that means that winning a customer is extremely important, and not losing customers is very, very important also. When you win a customer and they are satisfied, it's a customer for life. And we are happy that we have been successful in this extreme so far. The second one is the software as a service model, the fifth of the blocks. Software as a service is a new trend in the software market. Basically, in the past, you were buying a license, like some of you will remember Windows licenses, Windows 95 or Windows NT, this kind of licenses, and it was a one-off. And it was also in our software market for TV in the past. But now, more and more, instead of selling the software, we rent the software. What does it mean? Okay, the previous model was a CapEx model, basically capital expenditure. They were buying licenses, big upfront in general, millions, and then a few hundred thousands every year as support and maintenance, change requests over the software that we delivered, etc., etc. Now it's different. Now the entry fees are lower. The length of the contracts is longer, much longer, and we grow as our customers grow. This means front investment from software companies, but the recurrency on revenues is much higher. The visibility that we have in our future revenues is much improved, and this market is moving in this direction, and we are happy to say that we are in the right way now, and most of our proposals to customers are coming in this software service model. Some messages for the past year that we are just announcing, and I think that if I need you to keep important messages from us are most of them in this slide. Okay, first is that despite COVID, despite the pandemic, we had a very, very high level of revenues. We are quite resilient. So we came down, if we exclude the Connect, the disposed business from Connect, the parking business that we sold a couple of years ago, we came down from 12.9 to 11.1 million. Yes, it's a big reduction, but have in mind that we have not signed any new customer due to the uncertainties of the market, and no any of our competitors, okay, for the last 18 months. And even without selling any new customer, even without adding any new name to our list, we have been able to reach a level of 11 million when compared to 12.9. We are quite resilient. We have a very high visibility of revenues ahead, and this is very important. When you have a customer, then the revenue coming from this customer becomes quite recurrent. We didn't have much or no operational impact at all. Actually, we did 3 deployments during the pandemic with a complete lockdown. We are able now to deploy our services everywhere in the world without sending people, without sending any hardware, and this is extremely important. Our customers are getting used to that, and this actually becomes a quite strong point in terms of cost reduction. Not only on the operations, we have learned a lot during this year. We have been able to implement winning new sales strategy or seller strategy. We have started in the Asian region that we opened a couple of years ago. So let me just explain that in a bit deeper for the slide. But just to give you a number, we have multiplied in that region the number of deals in the same period, in a comparable period of time, by 9. Okay, multiplied by 9 the number of deals incoming. So this is very important, and we think this is working, and we are going to replicate that. In terms of technology and in terms of integrations, big year for us, extremely good year for us. First thing is that we have been able to launch worldwide our new generation of software for TV. This is based on a technology that is owned by Google that you will all know. It's called Android, and the TV flavor of this software is called Android TV. So Android TV is a big trend in terms of technology, and we are one of the most advanced companies in our sector in terms of the implementation of Android TV software. By number of boxes, by the size of our deployments, we are one of the largest references in the world and one of the biggest partners for Google. Despite being a small company, I think that we are doing good, really good there. The other thing that has been important in our year is the integration we have been able to do with different content providers. And when I say content provider, we are talking about the big majors, the big names that are producing content that come to your mind now, people like Netflix, Amazon Prime Video, Disney, HBO. We already announced last year the integrations with Netflix and Disney. We are working on integrations with others. We are happy to say that so far we have integrated with Netflix, Disney, Amazon Prime Video, HBO, Fox, and many others. The list goes on and on for until more than 30 now. And being integrated with all these content providers is extremely important in the new ecosystem we live in. I will also explain later what does it mean, but keep in mind, this technology advance in terms of the Android TV product and the integration with many content providers is very useful, very important, and I think that we became a quite an important reference in this market. We think that having these references and being in the forefront of the new edge technologies that our customers want to deploy, and having the references that we have that are, as I said, millions of subscribers using this kind of services, is leading to powerful new references, not only in customers, but in content providers that are integrated with our platform. I'm quite happy about that. In terms of pipeline, probably the most important thing now, the pipeline really boomed over the last 6 months, and there is a reason for that. Most of the customers, or all the customers, stopped their investment, the launch of new TV platforms, the things that we sell over the last year. And they only resumed their investment appetite and investment activity just before the summer or during this summertime. So we have those customers that just were waiting, and the customers that were due to replace the platforms they have this year. So there is like an aggregated demand in the market. As having the right products and more importantly, having a revamped, boost sales activity has made our pipeline much bigger than ever. We have never seen a pipeline this big, this good. And in terms of the quality of the leads, I think that we are sourcing very, very good new opportunities. So hopefully we will be able to give shareholders good news sooner than later. And in terms of the finances, obviously Gonzalo will give you a glance of that. We have improved our capability to afford the working capital needs of a business like ours, with the great support of our largest shareholder that just extended the facility we have with him to be able to have more headroom and cope with the needs of our market. So I will let Gonzalo just jump in. Thank you, Gonzalo.
Okay. So, hi everybody. This slide is quite consistent with the messages Jose has shared with you. You may see on the left side the significant growth, 28% CAGR growth we had in fiscal year 18 to fiscal year 20. On the right side, you may see the impact of COVID in fiscal year 21. Mainly the impact came from the lack of new RFP processes in the market, and also some reduction of investment from current customers. However, from March or April in this year, we have seen a reversion of this trend. We are participating in different RFIs and RFPs globally, so in different regions in America, Eastern Europe, Asia, and in Middle East. And we are quite confident to give some news, some positive news out of these RFPs in the coming months. If we take a closer look at our revenues, firstly, let me try to explain you what our main revenue streams. Our sales cycle starts when we have a contract win. Immediately after, we start the integration of our software with the platform of our customer. This generates some professional services that we bill the customer. When this initial phase is finished, then the customer starts the deployment of our software in the households of their subscribers. For each deployment, we charge a license fee. Typically, license fees depend on the number of households where the software is installed. And on top of that, we charge the customer some recurrent support and maintenance fees for the support we give the customer along the year for the basic functionalities. There is a fourth revenue stream because sometimes the customers also order some enhancements on top of our standard product. We deliver these enhancements and charge additional professional services. So that's why we see in this slide these three revenue streams. In the last financial year, despite COVID, we managed to show growth in support and maintenance. This is driven by the new deployments we had, firstly with Zappi, a customer in Spain, and second with the Android platform for Easy Telecom in Mexico. For licenses, you may see a very small decrease, $0.2 million. In the second half of the year ended in March 21, we see a recovery in these licenses, and this trend has continued in the first months of the fiscal year that has begun in April 21. In fact, if this trend continues, fiscal year 22, the year we currently are, could be the financial year with the highest level of license fees ever for us. And even the professional services has also recovered in the coming year, mainly driven by the integration of premium content providers. This is a market trend we see in most of our customers demanding the integration of these premium content providers, such as Disney+, Prime Video, HBO, Netflix, and others. So apart of working on our revenues, we have also worked on our costs. Here you may see that despite the decrease in $1.9 million in revenues, our EBITDA only decreased $0.8 million. This means $1.1 million in savings. The savings didn't come from labor because we consider that our engineers, our team, and their knowledge is a cornerstone of the company. So we have kept them intact to be ready for the new contracts and the new economy after the pandemic. And where we have focused all our savings is in fixed and overheads. In fact, this $1.1 million in savings represents approximately a third of the total fixed and overheads of the company. And if you consider the valuation of the US dollar versus euro in prior year, and considering that most of our costs are in euros, in fact, the real savings in local currency is over 40%. And additionally, we have maintained our investment in R&D that because we work on the short term in the revenues and in the cost savings, but we also have a look in the long term, and R&D is key for our success in the long term. Regarding our net debt, three key messages. The first one is that the debt has increased, that's true, but has mainly increased driven by the new deployments and mainly driven by the software as a service business model. That it has lower setup fees initially, but higher license fees in the long term, and this requires some financing in the first year of the deal. You may see also that we have signed new long-term deals, new long-term loans, both with private banks and with CDTI, that is a Spanish government entity that promotes R&D, with very interesting conditions, 3% with the commercial banks interest rate, 0.1% with CDTI, and in both cases, this is quite relevant, with no collateral. So as a consequence of all these actions, we have managed to have a healthier composition of our debt with a much higher weight of the long-term debt and a lower weight of our short-term debt. And back to Jose.
Thank you very much, Gonzalo. It has been a very important year for us, and I would like to give you a glance of what we have been doing and what we are planning to do. So a bit of a lower level description of the changes that we have made in the sales area. The important thing, we call this our road market strategy, the optimized sales network is based on resellers. So let me explain briefly how this works. Before making these changes, like approximately a year ago, a bit more, we had local representatives that were based in specific places in each region. So we had a representative for Asia based in the Philippines, a representative for Latin America based in Chile, and representative for the United States, etc. So we had, for each region, we had a sales guy, 100% devoted to MIRADA. And this salesman was visiting the countries, and usually he was meeting a customer once every 3 months, once every four months. And this was enough to maintain the contact, but not enough to push our product properly. We have decided to change that because having local people is much more important, but we cannot afford to have a local sales guy in every country we operate or we try to sell our services. So we have been following a different approach. And the approach is having a reseller network. What means is that we have partners that have a set of 11, 12, 10 different salesmen, and they have local presence. They know perfectly their customers. They work part-time for us. They work part-time for other companies that are complementary to what we do. So they don't sell any competitors' software. They just sell what we do and what other partners that we work with sell. So at the end of the day, they have a global view of the ecosystem, and they have bi-weekly calls with customers. They are visiting them once every 2 weeks, once every 3 weeks. This is very important to maintain the contact, but this is also very important to detect new opportunities. So they are closer to the customer. They are able to identify new opportunities in the customers that we already had in mind, but they also find new customers that we didn't identify because we were not there. Okay, so to give you the statistics, in 9 months of activity of this reseller network in Asia, we multiplied by 9 the number of potential opportunities. So the sourcing of opportunities now is much more agile, much more efficient, and we are going to replicate this reseller network strategy in other areas. In terms of cost, the cost per new lead is actually the same. So it's quite important that we are reinforcing the sales area. That is probably the most critical point that we changed in the last year, apart from the technology advancements, and we are expecting this to have a result. So clearly, most of our new deals are based in Asia because of this strategy, but we also have quite an important number of potential opportunities in other areas like Europe and the Americas. Being local is also important for other reasons. Obviously, the pandemic not having the possibility to travel overseas or to go to the other country, having a local guide that is meeting the customers there have been very useful. We perceive that this market trend in terms of not visiting the customers to make a demo, to talk to them, is going to continue. So probably the sales cost in terms of travel and expenses will reduce dramatically. What we are seeing is that having a very good online platform to make demos is key. And we have invested a lot this year in terms of having a very good demos platform. So 90% of our new opportunities now are coming from our capability of making an online demonstration, full demonstration of our product. In the past, we needed to go to the country, say Malaysia, bring all our equipment, installing this in the customer premises, and the presentation was very good, but the fact that they couldn't use absolutely everything, because you cannot travel to a country with hundreds of servers, etc., was quite complicated. So now that it's all based on the cloud, our sales capabilities are all based on the cloud, makes it much more flexible. Our customers can use our demos online. We can open, close accounts, and etc. And it's becoming much more flexible, much better experience for the customer, and the sales cycle is more dynamic now. In terms of what we have been up to in terms of customers, let me just highlight 3 of the customers and the most important things that happened on them, the key things that happened on most important customers during last year. So I will start with Easy, that is our biggest reference so far. We have been, and I'm happy to say that we have been integrating with Disney Plus, Amazon Prime Video, and HBO Max, apart from the integration with Netflix that was announced before. They launched the Android TV deployment that replaces the legacy technology, our legacy technology, from November. So this means effectively that with Easy, we are in our second life as a supplier. So they have replaced their prior technology that started in 2015 with new technology starting in 2020. And this new technology has been quite successful. In total, in terms of our customers, we are deploying nearly 100,000 set-top boxes containing Android TV a month. And this is extremely relevant. I will tell you why a bit later. Okay. But Easy is one of the largest Android TV deployments worldwide, and in fact, the largest in Latin America, as far as we know. And up to 31st March, the customers base with set-top boxes was 2.9 million set-top boxes using our technology in Easy. And in terms of our streaming technology, that includes the web, includes iPhone, iPads, smartphones like Android and others. They had about 1.2 million households using the technology. So effectively, we have just in Mexico more than 4 million devices using our technology day after day. And this is very relevant. We are not a startup anymore. We have a very good and consolidated product with millions of subscribers in only one customer using it at the same time. So the product is quite resilient, and we are clearly a tier 1 proposition. We also have smaller customers, quite promising ones. We announced SAPI in the last fiscal year. We completed the commercial rollout late in last year. It's a multi-device platform. It also includes, apart from what I told you, that Easy has things like console platforms. So it also includes smart TVs like Samsung, LG, Android-based smart TVs. So it's a whole plethora of devices you can use to access the platform. Even if you don't want to have a set-top box in the household, you can have our service. So this is very important. We also did this deployment remotely. Despite SAPI being based in Spain, we didn't need to travel to the customer premises. SAPI is quite a unique example, a unique case that can be replicated in many other markets. SAPI is an umbrella for many small cable operators or IPTV, or basically pay TV operators that are local ones, addressing basically towns and councils. So some of them have 5,000 subscribers, some of them have 20,000 subscribers. But so far, we have nearly 60 operators under this umbrella being integrated and deploying the service to their subscribers. And the potential for this customer is we are expecting to reach a mark of about 600,000 subscribers on the customer words. So this is our biggest launch in Europe. It's working quite well. It's also based on Android TV, and well, we hope we can give you more news about SAPI soon. And ATN International is a customer in which last year we already had a deployment in Bermuda. ATN is a NASDAQ-listed company based in Atlanta. They have properties being operators, pay TV platforms. This deployment that we did in the prior year was in Bermuda. Now we are covering more than 90% of the households in Bermuda with our service. And this year we are glad that we were able to deploy again a 100% remote operation, a new country, in this case, the US Virgin Islands, with the operator Vija. And it's working quite well. So I want, over 3 slides and coming near to the end, I want to go a bit deeper on the super aggregator strategy. What's super aggregation? It's important to define this concept for those of you that doesn't know it. And let me explain. Most of you will have 2 or 3 subscription video on demand services like Netflix or Hulu or Amazon Prime Video or HBO, and you are using them. You could have a pay TV platform or not. You could have these services under the TV platform or not. But if you are using these streaming services, you will know that they are the big majors now. They are the ones that are really producing the content. If you look at the right of the screen, Emmy Awards just last month were quite amazing. 44 of the trophies went to Netflix, 19 to HBO, 14 to Disney+, 10 to Apple TV+, and just 13 to the prior players, to the old players, so NBC, ABC, etc., etc. So just Netflix got more than 3 times the prizes, the trophies that all of them together had in this year. This is because these distribution platforms are becoming majors, and the majors are becoming distribution platforms, like the case of Disney. Netflix and Disney are different animals, but they are becoming very, very similar things. Netflix was before just a DVD rental business, and they decided to create what is called the streaming window. And they were able to reach agreements, temporary agreements, for the distribution of almost all content. So if you remember Netflix a couple of years ago or 3 years ago, you could find almost everything in Netflix. All the majors that didn't have a distribution service basically were just selling this content to Netflix for a few years. But slowly, Netflix started to lose all these rights to distribute the content. And now if you go to Netflix, most of their content is actually Netflix originals, as they call them. So Netflix has become a producer of content, nearly 19 billion this year in terms of investment in content, one of the top 4 in the world. HBO and Disney were following exactly the opposite route. They saw the emergence of Netflix as a window to access customers, and they decided to create their streaming service. Now they are all the same, a good streaming service with a big production house behind. Okay, the way they have to address customers is double. You can access Netflix or Disney Plus either subscribing directly. You can have a subscription with Disney Plus or with Netflix, or you can have this as a part of a bundle, a package that is part of your broadband supplier proposition. They are coming with broadband, they are coming with perhaps mobile telephony, and they are coming with content. In terms of content, 10 years ago, if you were looking at Sky, basically what you had were 200 channels in a grid. Okay, and you had the possibility to switch from channel to channel, and it was all linear content. This changed rapidly, and more than 50% of the consumption of the eyeballs now are on the on-demand consumption. People are no longer watching linear channels, basically traditional channels anymore. They are going to on-demand content. Most of the renewals players have are based on the on-demand rights. And if you go now to Sky, or if you go now to Sky or others, then you can see that the proposition is different. They have a big library of on-demand content, and they need to show you what they have on the search and recommendation tool. I will repeat, search and recommendation tool. A big difference between the search and recommendation that you have when you have several vertical platforms and when you have a unique umbrella, when you have a super aggregator, is that if you have Netflix, Disney, Amazon Prime, you need to go application by application searching for what you are looking for. So I don't remember now who has the rights for, say, Back to the Future 2. Okay, but I would need to go to Netflix, and then if it is not there, to Disney, and then if it is not there, to Amazon Prime Video, and perhaps it is not in any of the platforms I'm subscribed to. The platforms, the D2C propositions became silos of content. They have mainly what they have produced and a few distribution agreements. If you have several of them, it's completely well, it's very difficult to find the content. And one statistic for you, between 110 and 140 hours is what an average citizen spends in looking for content a year. So it's many hours, more than 100 hours a year. Any one of you is, if you are an average consumer, is dedicated to find what they want to watch. Find what you want to watch. You have several options, and all these options are actually a problem because you need to use several applications. So here, the benefit of a super aggregator. If you have one tool, one platform, one player that aggregates all this content and gives you one search tool, this is very, very, very powerful. We didn't invent this. It was Chromecast, mainly in the US, and everyone else in the world is following this model. Easy in Mexico is following this model. All our customers are following this model. And now the importance of the platform is much more critical in terms of who are you integrated with. Our platform is integrated with the big names now. We are integrated with Netflix, we are integrated with Disney, we are integrated with HBO, Fox, name it. So the integration, and actually replying to one of the first questions that we had in advance, is when we integrate with one of these content providers, we make this content available on a super aggregator, on a platform, on a pay TV software that we provide. This means that the highlights section, the search and recommendation, the magazine, the experience is comprising all this content. You don't need to go outside of the experience of the main experience of this pay TV player to access this content. Yes, you could be jumping from this application to another application, but your landing page, your landing point will be this one. This is extremely powerful. You could even have some discount as a bundle in the subscription. Why is this also important for these players, for HBO, for Disney? Well, I will tell you, most of the growth of these players is actually based on agreements with pay TV platforms. Why is it? Two reasons. The first one is that the cost of acquisition for customers is quite high. If you are going on a direct-to-consumer model, on a D2C, the cost is much, much higher than if you just sign an agreement with a distribution platform that has hundreds of thousands of subscribers, and they automatically become a potential customer. They could join a package or they could not, but you have someone selling for you in hundreds of thousands of subscribers at the same time. The second and most important part is that the churn rate, the rate at which your subscribers are going off the service, is much lower in a bundle. It's much lower in a pay TV platform. Why is that? Well, you have not only the TV, you have the broadband, and probably you have the mobile phone. So even if the churn rate is high in the telco market, it's much, much smaller than in the D2C market of these content providers. So add these two things, the cost of acquisition of a subscriber and the chance that the subscriber is going out of your platform, and it makes a win-win. It's a proposition of having your content in a pay TV platform, and for the pay TV platform, having all this content and having a search and recommendation tool that provides a brilliant entertainment service is a win-win proposition. We have been able to do this technical integration to provide the content and the data about the content, that's called metadata, by the way, to our customers. And the fact that we have all these integrations done so far makes new customers much more powerful, because they don't need to redo integrations. Once we have integrated with Netflix, it's integrated. Any new customer will just need to reach a commercial agreement with this content provider to be able to display their content in their platform. So the time to market for a solution that is a super aggregation-based solution, in our case, it's much shorter, and hopefully our customers will continue appreciating that. The second point I would like to share with you is Android TV. Android TV is the fastest growing technology in TV platforms now. You will all remember what Google did with Android for mobile phones years ago, and now they have nearly 90% of the operating system of all devices in the world. This is the fastest growing trend. Google is also willing to be in the TV devices. They are in the smart TVs, they are in set-top boxes. And in terms of set-top boxes, these small devices that you put alongside your TV, they have been the fastest growing trend in the market so far. In year 2019, they had less than 10 million. Last year, they ended with about 12.5, 13 million set-top boxes. This year, they will finish with about 20 million set-top boxes deployed in the world. Just have in mind that we are deploying nearly 100,000 set-top boxes with Android TV a month. So, very important. About 1 in 7 set-top boxes deployed with the Google technology, with this Google technology in the world at this moment, contain MIRADA software. I think that is a bright achievement for a company our size. And obviously, we have an extremely good relationship with Google, and we consider ourselves one of the best partners for Google in terms of the number of deployments they are making of Android TV in the world. And especially in Latin America, this is completely relevant, the largest by far in Latin America at the moment. One thing that, and to give you a hint of why Android TV is relevant for our customers, Android TV not only gives you things like voice recognition or a much better search tool that is integrated with our unified search experience, also gives you the Play Store, the ability to use other applications apart from the application from the platform. So the capability of integrating new services that play quite nicely with your TV services is very powerful in these boxes. In the prior boxes, the integration levels, the cost would be much higher. So the cost of Android TV boxes is very similar to the legacy boxes, and this is why Android TV is becoming so successful. And we are happy to be one of the largest deployers of Android TV technology in the world at the moment. A bit word about D2C. Yes, I was talking about that Disney Plus, HBO with HBO Max, Netflix, all these players will continue deploying their direct-to-consumer propositions. They will want to have a link with subscribers. And despite having a very good relationship with the pay TV players, they need to build platforms. They need to become relevant also. So it's a dual strategy. And in this dual strategy, some of them need to have a TV platform. They need technology like the one that we provide. So one of the lines that is growing, and we are expecting this to become more relevant next year, is the D2C line for our technology. So not only having pay TV players, the traditional players on TV distribution, but the new players, the new D2C players, because our technology is extremely relevant for them. We have the software present in almost all the devices that consumers want to use. And the capability we have also with integrating not only with the final subscribers, but with the operators makes us a very, very relevant partner. So my understanding is that this could be also a way of diversifying our revenues in the years to come. Okay, so just looking ahead, what we are expecting, and a couple of slides. First, a summary and outlook. We are seeing record levels of activity. The market is back. It was sleeping and with no new investment appetite during the last 15, 18 months. Now it is back, and now we are a relevant player in this market. We have many opportunities, and hopefully we will be able to land some of them shortly. We have been able to deliver in this pandemic, and we continue delivering remotely, 100% remotely. So this means that our operational dynamics now are more efficient, and this is quite appreciated by our customers. Our sales strategy is new and is proven right. So obviously what we are going to do is we are going to replicate the sales strategy in other areas. We are actually quite advanced in the United States, and we will announce that on due course. In terms of financing, we are very happy to have a very supportive shareholder, and we are happy to have institutions, banking institutions, and the Spanish government supporting our growth. So we have all these facilities that can help us to be able to fulfill our working capital needs. In software as a service model, there are working capital needs, and we are happy to have the partners and the interest of the market in this extent. We have very ambitious plans. We think that we are at the forefront of the TV technology now. We are one of the top players. And in terms of super aggregation and Android TV technology, I will say that probably we are in the top 3. So my understanding is that if you are there, you have the references, you have the technology, you are in a very good position to win new customers, and we are there at the moment. Okay. So why invest in this company? And this is the last slide before Q&A. We are in an expanding market. The global TV market, the video consumption, the video entertainment industry is growing in a mixed model that has the old actors, the pay TV actors now becoming super aggregators with their broadband capabilities, and the new actors that are the D2C. We are present in both. And our aim is to be a very relevant player in this software provision for this market. Okay, the market is worth about 120 billion by 2025, over 1 billion users. We hope to be at least one of the top 10 players there by that time in terms of sales. Leading software market for TV and video services. Our research and development has been quite efficient, and we have very good products. With the size we have, we are competing very well in terms of our technical capabilities. We in the last 6 months or a year, I would say, we didn't come second. We came always first in terms of the technical evaluation for all the deals we have been participating on, and they have many. Most of them, all of them actually, most of them are due to make a decision in the next months. So my understanding is that being a leader software provider with 85% of our workforce being engineers with a lot of experience, very high level of research and development to continue being relevant is important for our customers. In terms of the model, we have been able to transition to recurring revenues through software as a service model. This means a much higher level of visibility on future revenues. Software as a service deal in our case means lower revenues in the first year, but at least a 5-year long agreement with increasing subscription fees, subscription-based license fees in a monthly basis, usually. So our customers pay a license per month for the usage of our service by a subscriber. We grow as they grow, and obviously we have minimum revenue guaranteed for our contracts, meaning that actually our margins over a 5-year period are higher than in a capital expenditure model. This requires an investment on our side, but this increases a lot the visibility on future revenues for the company. So we understand that this is quite valuable for our shareholders. And we are positioned for future growth. If we didn't have, well, nobody will know what happened if we didn't have the pandemic, but we were growing at a circa 30% year by year CAGR. So 30% yearly growth is a lot. This company, and you can make numbers, this company can make money between 15 and 16 million in revenue. Our cost base is quite stable. Our research and development investment is quite stable also. As Gonzalo said, this year is set to have our highest year in terms of license revenues to date. This is because of the prior agreements and because of the growth of the platforms we have been deploying our software in. So obviously, those recurrent revenues are very important for building the growth of this company, piling up new customers on top of the agreements that we had in the past. 2021, we just finished, has not been a great year in terms of revenues, despite being quite resilient. We are catching up this year, obviously, and we are expecting to recover this trend of growth very quickly. Gonzalo said this H2 is proving to be strong, especially in terms of licenses, and we are hoping that new customers will come in the very near future, and we will be able to give very good news for our shareholders soon. So now we have finished the presentation and we are jumping into the Q&A.
That's brilliant. Jose, Gonzalo, thank you very much indeed for updating investors. Could I please ask investors to continue submitting your questions using the Q&A tab situated on the right-hand corner of the screen? But just while the management team take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we will notify you by email when it's ready for your review. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation's ended, we will redirect you automatically for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Jose, Gonzalo, you can see, if you would be so kind as to open the Q&A tab, that you received a considerable number of questions throughout today's presentation. If I could ask you please to read out the question and give a response where it's appropriate to do so, and I will pick up from you at the end.
Okay, thank you very much. Gonzalo, please join me on the screen if you can. Yes, I think I can remove the slides from here. Okay, fine, perfect. I will try to go in order. Okay, so we have a question from Siddharth. Mirada's product is gold quality and fills a very relevant gap in the market. However, contract wins haven't been very strong. What's the reason? What are you doing to improve contract wins? The pandemic was a big showstopper for our customers. They didn't want to make any decision in terms of investment. They stopped. They froze all the investment that they had in calendar year 2020. They are restarting this basically after the Q2, and we have many opportunities now because those customers are now willing to invest. What are we doing to improve contract wins? Well, we have improved our sales strategy, and I think that the new road to market strategy we have is quite relevant. We are watching a very relevant increase of opportunities in Asia, and we hope that replicating that in other parts of the world in which we also have a good activity can prove right. This is what we are doing, and frankly speaking, I understand that this is the way to go. I think that, Chris, you were asking what does it mean to be integrated with likes of Netflix, Disney, etc. What does it mean for revenue and sales? Being integrated with Netflix, Disney, etc., the integration itself is a revenue source because doing this integration for our customers, the pay TV platforms, is actually generating revenue for us in terms of professional services. More important than that, being integrating with those content providers is the right way to build a super aggregation strategy, to become the way to provide a super aggregation service to your customers. So once you have been integrating with all these players, all these content providers, you can go to a new customer and say, look, I have been already integrated with Netflix, Disney, Amazon Prime Video. If you want to launch a new service, you will be much better doing that with me than with a competitor that didn't have this experience before. So it's good also for sales. Okay. In terms of the software development cost question, do you expect what is the level, and what do you expect R&D cost to stabilize or reduce as the product stabilizes? The answer is yes. We understand that there is a basis in terms of research and development that we will need to invest year by year. It's very difficult that we will invest a lower figure than 20 or 25% of our revenues in a recurrent basis. We had peaks of investment related to this Android TV integration and with super aggregation integration. So probably our research and development investment this year will be lower than last year, but it will still be quite relevant when compared to our revenues. It's below the licenses revenues level. So licenses coming from our customers are paying for the investment that we are doing in our products. We want this return to have higher margins in the future as we continue having an increase in our research and development, stabilized in terms of percentage of our revenues, but an increase in our revenues through long-term agreements that will produce license fees for us. I hope that I was able to reply to your question. Next one is from roughly what revenue level do you expect to start growing through operational cash flow instead of using debt equity funding? I think that I replied to this question. My understanding is that between 15 and 16, but closer to $15 million a year is a level in which we can produce cash flow. Another question. I assume that your regional resellers have exclusive contracts with you to sell MIRADA products in the region. Have they been meeting to your KPIs to keep their exclusivity? They have so far. We are happy with them. As I said, the level of sourcing of new opportunities have been extremely high, and they are keeping the KPIs so far. We want to have this consolidated also in a KPI that they didn't need to meet in the first 6 months of activity, but they will need to meet in the next few months. That is contract wins. So in terms of RFPs, RFIs that we have been invited to, we are quite satisfied, and we want now to come to the last point in which we are able to announce to our shareholders that we won a deal in any of these regions, especially in Asia, as I said. Okay. Paul is asking, please tell us more about the pipeline. Are you able to quantify in some way and give us some metrics? How does it compare with consensus revenue forecast for fiscal year 22? What's the average deal length over which revenues will be recognized, and does the cash match the revenues? In terms of the pipeline, in terms of qualified opportunities at the moment, we have more than 60. In terms of those that I would say that could make a decision in the present year in which we are involved at the moment, it's about 10. It's higher than what we anticipated when we made the forecast. The average deal length is about 5 years. Software as a service models are 5-year models, and even if we are going in some customers, we are offering CapEx models because they are really big customers and they want to go for a more upfront proposition. Usually, it's a very long-term contracts, 3, 4, 5 years, because we want to maintain a level of support and maintenance for those customers, an upgrade on the product that is called. There are also licenses. I don't want to go deep on that, but there are also licenses that are called software upgrade subscription licenses. Another question from Paul. Cash received on loans of the last 2 years is just over 5 million. Is more money available from this source if the fiscal year 22 ramp is slower than you currently expect? Do you want to reply to this one, Gonzalo?
Okay. Well, last week we announced an extension of the loan we have with LEASA. The extension is approximately for $2 million. So in case we need more cash during fiscal year 22, we have these $2 million available.
Okay, thank you, Gonzalo. Another question. You say that you are a top 5 software as a service supplier. We are a top 5 supplier of this kind of software for pay TV platforms. Most of the deals are now coming in software as a service. So yes, we could say that we are a top 5 software as a service supplier, but in general, I think that we are a top 5 supplier in this market. Our top 3 competitors, there are many competitors for different tiers of the market, tier 1, tier 2, tier 3, depending on the size of the customers. I would say that our biggest competitors at the moment are Minerva, based in the United States, B-Access Orca, based in France, and Xperi Tivo, that is based in the United States also. There are so many other competitors. If you want to have a deeper conversation on that, I will be happy to talk in a separate room. How should investors attempt to size the opportunity for MIRADA? Well, multiples are usually a good way to value a company like ours, especially when we're in a growth stage, multiples of revenue. We are not valued in terms of market cap at all, where my humble opinion is that we are not valued at all in terms of multiples. Most of the reason of our low liquidity level and probably fear from some institutional investors to join the company is because the situation in terms of our largest shareholder that owns approximately 87% of the shares. We can discuss about that a bit later, but this is important. So my understanding is that as soon as the customer recovers the trust in our proposition, the market is more relaxed about the position of our major shareholder. They will start evaluating us in terms of multiple of our revenue or multiple of EBITDA. Okay. Presently, the market cap is about £6 million. There's roughly $8 million. Our revenue level in probably a very bad year in terms of what we could have achieved, and we then, because of COVID, it was 11 million. The prior year was 13 million with an EBITDA of about 2.5, 2.7. So take any multiples. We are not just a seed company. We are not a startup. So you can use the revenues, you can use the EBITDA to make your valuations for the company. Do you plan to sell B2C services through your Android TV application so that the customer can use Mirada's platform as an aggregator of, say, Netflix, HBO, Disney, etc., without going through a Sky or Virgin Box? Well, we will be, in this case, we would be competing against our main customers now. So it's a risky proposition, and we would discard that at the moment. Okay, there is a way in which we can produce, and directly we can produce direct-to-consumer revenues. One is obviously the fact that as our customers grow, we get a part of their revenues because they will pay us a part of the subscription fees of their subscribers. So it's just an hypothesis. Imagine that the customer is paying us $1 per subscriber per month, and the subscriber is paying them $15, $20 per month for the TV service. We are getting a 5%. 8%, 6% fraction of their revenues. So we participate indirectly in the D2C market. There is another way, that is the advertising market. We didn't talk at all about advertising today, but advertising is becoming also a big trend. Most of the audiences are now migrating to the on-demand world, and these eyeballs are actually in a different place than they were before. They are in applications like our applications. So the real estate, the space in these applications that can be used to sell advertising is quite important. So we are working, and I think that we are pretty much well positioned to participate in the business of advertising when our customers are willing to take a part of the pie. Ryan, thank you very much for your words. Amazing stats with Google. How do you see this moving forward? Do you feel you will get greater market share? Well, I would be actually happy to have this level of Android TV deployments per month for a long time. I understand that this is going to grow as we continue winning customers with the Android TV technology. We should become more and more relevant as I said, the technology, I believe, is superior, and the reference is there. So yes, I cannot say anything else than yes. I feel that we will get greater market share in terms of the share of the software investment that pay TV platforms and premium content providers make in technology. Many questions. I hope that I will be able to catch up. Another question, how does Mirada's product compare with new Android TV solutions provided by Google Chromecast, Xiaomi Mi TV, Roku, etc.? These are Android TV technologies based on a retail market. Let me explain. You buy a Xiaomi box in your store, you plug it to the TV, you have several applications, you use one of them. One of these applications could be, say, a Movistar application. Movistar is a customer of us, but not in the main product that you are seeing. And you will access to Movistar there, but you will have the Movistar application, the Vodafone application, the Orange application that are competitors in Spain, exactly the same landscape in the UK or other countries. So you don't own really the HDMI one. You don't own the big TV experience. When you are using our Android TV technology, you switch on the TV, you switch on the set-top box, and you have the brand for Vodafone, or you have the brand for Easy, or you have the brand for Villa. Okay, this being the case, you control the experience. The other thing, the retail market is a very useful one in terms of the capital expenditure that an operator needs to make. We call this the bring your own device strategy. We call this strategy is also quite a good complement. It's complementary to what they do on set-top boxes. We also use this kind of devices, all of these kind of devices in customers like Sappi in Spain. So we are in both places, but we understand that the Android TV operator tier, is it called, the Android TV operator flavor of Android TV technology, that is what we are deploying, is extremely relevant, and it's a much better proposition for a super aggregator. I hope that I was able to reply to your question. Another one, when you say you are in the top 3, who are the 2 other 3 competitors? I think that I already replied to that. Please remind us the free float and why your main shareholder doesn't just take you private. Very good question, Murray. The free float is about 15%. That is very low, but this is not a real issue. The real issue is that we have a shareholder that owns, 15%, actually 12%, that owns 87% of the shares. So I will reply this question quite straight. If he wanted to take us private, he would have done that now, and he doesn't want to, or at least every conversation I'm having with our private, with our major shareholder indicates completely the opposite. He understands that in the long run, the market will value what we do, because as we said, considering the multiples, it's quite unlikely that the market cap will become or will have this kind of relationship with the progress that we are making. So there is a plan to continue public for the long term, and actually probably the best strategy, and this is the one that I have been discussing with our major shareholder, and I'm pretty convinced that this is the way to go, is that with new potential equity injections in the company coming from contract wins that we could have, our largest shareholder would be comfortable to let other, at the right price, to let other investors join the list. This is very good news. This is something that I believe that the market is looking forward to have. This is something that I would be more than happy to recommend to our board of directors and to our major shareholder. And I think that the stars would be aligning there, having new contract wins, having the right reasons to invest in this company, having other shareholders that will much probably keep our largest investor in a majority position, but not in a position over 70%, say somewhere over 50%, would relax a lot some of our potential new investors. So I believe that we are going to follow this path. I hope that I replied properly, Murray. I cannot put any words in the mouth of our largest shareholder, but I'm fairly convinced that this is the right strategy and that we are aligned in this extent. And if you have any more questions here, I'm happy to address them. Another question, and I think this is the last one, hopefully. Anyone else willing to make more questions, happy to reply them by email. What sort of revenues do the top 3 competitors generate? On a blue sky basis, what revenue MIRADA generate in the medium term? Some of them are, but most of them are not public companies, so it's difficult to say. The 3 competitors that I mentioned are bigger than us. So obviously they generate revenues that are more in the range of $20 to $30 million each. Some of them much bigger than that, like Xperi, TiVo. We expect to be there. We expect to become, not only in terms of our technology, our participation in the deals, our technical valuation, we expect to be there also in terms of revenue. So we have a quite aggressive growth strategy This is very well supported with the number of opportunities we are participating on. It's well supported by the product level that we have, the technical capabilities and the agreements that we have been consolidating so far, not only in terms of customers, but in terms of other partners like the content providers, Netflix, Disney, Amazon Prime, in terms of technology providers, technology partners, Google, Apple. So I'm happy to say that we are in a very good position to be able to fulfill our expectations in terms of growth. I cannot give you more than what our broker forecast says. We are going to complement that, and I can announce that we are going to complement that with more external analysis. So you will have the capability to compare different forecasts, and you will make your own judgment. The only thing I can say is we are working hard. I think that we are doing a good job here. And the way to demonstrate that is to win new contracts. And I hope that we'll be able to fulfill your expectations very soon.
Jose, Gonzalo, thank you very much indeed. I will jump in now just because I know we've gone through the hour, and Jose, honestly, you've answered every single question that's come through. So thank you to all those investors that have taken the time to submit questions, and of course to you guys for taking the time to be so detailed in your responses. Jose, I know investor feedback's important. I'll shortly redirect investors to give you their thoughts and expectations. And I know you've probably touched on everything, but if I could just ask you for a few closing comments just to wrap up, and then I'll direct investors to give you feedback.
Yeah, we have a very good proposition. We want investors to really know us. We want investors to understand what we do. We want them to understand why we have been growing before the pandemic and why we are growing after the pandemic. We have a very good team. We have very good supporters. We have the right partners. We have the right names in our list of customers and partners. And really, I believe that we have a great company, and I hope that our shareholders will be able to share our views.
That's great. Jose, Gonzalo, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. It will only take a few minutes to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of MIRADA, we'd like to thank you for attending today's presentation. That now concludes today's session. Good afternoon, and thank you to you all.